RSI indicator has a big problem, and the problem is you set a fixed look-back period for the RSI length and you expect it to work perfectly for you in every market condition. No, if you're an experienced trader, you definitely know that the market condition constantly changes, and so your indicator needs to adapt to the current market condition. Otherwise, it will not work properly. You cannot expect to have a static tool that works perfectly in a dynamic condition. This is not possible. So we need to have an RSI that dynamically changes based on the current market condition. In other words, the length of RSI should not be fixed and it should change and adapt to the market condition. And the good news is that recently a new version of RSI is published on TradingView that has this excellent characteristic. To add it to your chart here, you just need to click on indicators and search parameter-free RSI, this one, which is written by someone named Investor Unknown. Alright, this is the indicator, and as you can see, it is added here below the chart. This new version of RSI dynamically changes the calculation length based on real-time market condition. For this purpose, it considers two factors: volatility, which is measured by the standard deviation of past RSI values, and momentum, which is measured by the absolute deviation of the RSI line from 50, which is reflecting the strength of bullish or bearish momentum. So now we have an RSI that has the ability to change its length based on the current volatility and momentum, and this is a great advantage for this indicator. As you know, experienced traders never rely only on indicators because they know that indicators are limited, static, and lag behind the price. So they use a combination of indicators and price action analysis, because by the help of price action analysis they can read the price chart in real time, so they can dynamically evaluate the forces of buyers and sellers in the market, and because of this they can adapt to the current condition of the market, so they can align themselves with different phases or structure in the market. If you're interested to learn price action analysis, recently I published a book, The Art of Price Action Trading. The link is in the description and you can get it later if you're interested. Alright, getting back to the indicator, here in the settings of the indicator, here in this part, you have three options to choose for calculating the dynamic length, so you can adjust the responsiveness of the indicator based on your trading strategy. Variant 1 is aggressive, and it's a good choice for traders who want highly sensitive signals in fast-moving markets. Variant 2 is moderate, and it's generally suitable for most soft trading scenarios. It gives you a balance between responsiveness and stability. And variant 3 is conservative, which gives you a stable and less responsive length and is suitable for traders who want consistency from the indicator, not very reactive behavior. So depending on your trading strategy, the market you're trading, and the degree of the risk that generally you're willing to take, you can choose the proper variant here. And for the RSI moving average line, you have two options, which are simple moving average and exponential moving average. I prefer SMA because I want it to be smoother and less responsive. And for the length, I mean the length of this moving average line, since we don't have any fixed length for our RSI line, so it needs to be calculated by the help of a method. Full uses the entire calculated dynamic length, half uses half of the dynamic length, and square root uses the square root of the dynamic length. If you choose square root, this will make the moving average line very close to the RSI line, and this can increase the number of crossover signals, which potentially many of them are false signals. Between the other two, I mean full and half, when you choose full, the moving average line becomes smoother and farther away from RSI line, and when you choose the other option, the half, the line is more responsive and closer to the RSI line. As you can see, choosing half is a good choice since this is actually our signal line and we don't want it to be so far from RSI line. Alright, this was the explanation of the settings, and let's see what we have here. This white line here is RSI line, and the yellow line is the moving average of the RSI line. Here we have also another line which shows the current length of RSI for your reference. You can clearly see that the length is dynamically changing, which depends on the market condition. It is not fixed at a value anymore, and it increases or decreases depending on the market condition. In this indicator, when there is a crossover between RSI line and its moving average line, the area between between them becomes green or red depending on the direction of the crossover. When RSI line crosses above the moving average line, this is actually a signal for bullish momentum and the area becomes green. And when RSI line crosses below the moving average line, this is actually a signal for bearish momentum and the area between them becomes red. As long as RSI line is above the center line, we have green bars like this, and on the other hand, when RSI line goes below the center line, we have red bars like this. While the RSI line is above the center line and we get bearish crossovers, which are the times that the area between them becomes red. In this situation, while the RSI line is above the center line, the market is considered to be in an uptrend, and similarly, while RSI line is below the center line and we get bullish crossovers, which is actually when the area turns to green, these bullish crossovers can be just temporary weakness in the form of pullback, and as long as the RSI line is below the center line, the market is considered to be in a downtrend. This indicator does not mark overbought or oversold levels, so in case if you use RSI for identifying overbought and oversold conditions, you can add horizontal line at 70 and 30. When it comes to RSI, one of the best signals that you can get from this indicator is divergence. Divergence happens when RSI and price don't agree on the same direction. For example, here you can see that the price made higher high, but when you check RSI, you can see that RSI made lower high. This is called bearish divergence, and it shows that the upside momentum is weakening and the downside momentum is gaining strength, and this gives the possibility of having a downside reversal. But we need more confirmation because this weakness can be temporary because of a pullback within a trend, or after the divergence the price may go to a trading range before any possible reversal. So when we have a divergence, it only means that the prior trend is weakening and there is a probability for having a reversal. The most effective way for confirmation of a reversal is using price action analysis. Here in divergence pattern between the two highs, here we have a sewing low, which we mark this low and we wait for a candle to be closed below this level. When this happened, it shows that the structure of the prior trend is violated, and this increases the probability of having a reversal. So when the price is closed below this level, the reversal is confirmed and we can enter a short position, and you can see how the price turned to a downtrend. On the other hand, when the price makes lower low but RSI makes higher low, this is a bullish divergence, and it tells us that downside momentum is weakening and the upside momentum is gaining strength, and this gives the possibility to have an upside reversal. As I explained earlier, during pullbacks within a trend, we can have divergences, so we need more confirmation, and the best way is price action analysis. Between the two lows, here we have a sewing high, which we mark this high and we wait for a candle to be closed above this level. When this happened, we have higher probability for the reversal, so we can enter a long position at this point, and you can see how the price turned to an uptrend. Please pay attention that no indicator or trading strategy will give you 100% guaranteed signals. This is not possible in reality, and losing positions are always part of the game, and you need to manage your risk properly. Otherwise, you will lose your trading account sooner or later. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. By the help of this risk management strategy, you can limit your losing trades as much as possible, so you can protect your trading account from falling significantly. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.